Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 49 of Carson's Facts versus Feelings with Ryan and Sonu. 49, Sonu. What are we going to do for 50? Are you going to break out the guitar next week by comment?
Yeah.
Everyone's excited about that. Yeah,
the acoustic or the electric? You know. Maybe
whatever you want.
Whatever.
Yeah.
Whichever side I get up on the bed that morning. So it's a mood thing usually, but we'll see.
Exactly. Now, Sonu, this is going to be a fun one. We're going to kind of maybe have a little more fast-paced, talk about a lot of different things. We're titling this one, Busting 7 Common Myths. There's a lot of different common myths, from debt to credit cards to student loans, excess savings, bankruptcies. We're going to get into all of them. I think these are common questions we've heard a lot about. But before we go there, to the YouTube listeners, you're glistening a little bit. Are you sweating by any chance?
I'm always sweating, but now I'm sweating a little bit more. I just dropped my kids off, and I realized that I kind of shafted you guys on the timing of the podcast. I was like, oh, here I am, calmly waiting for my kids to go into school. They're in the first grade line. And then Ryan calls me up and say, hey, where are you? Are you joining the podcast? I'm like, I'm at school. I will hustle back on my bike. And, that's what I did. And hence all the, the glistening.
Yes,
I like the word glistening instead of sweat. So.
Yeah, I think that's what we'll say. Sonu is glistening today, but no, we just had Chelsea, our producer. We're just hanging out. Like, I don't know, maybe I'll just call him. I was like, I bet he got mixed up. I joked to people. So I'm in Eastern time, right? Carson Group is based in Omaha, the Central Time, and I said the hardest part for me about this job the first 4 months was getting the whole Central Eastern time thing figured out. Once you get the time zones figured out, it's not too bad. But anyway, all right. Well, Sonu, glad you could make it. Oh, go ahead. Mm-hmm.
Have you figured out EST versus EDT, CDT, CSC?
No, I don't know what you just said. No, I don't know what that even is.
I can never figure that stuff out. Savings, savings.
Yeah, like last week I'm in Denver, right? And like my phone's one time, the laptop doesn't update to the other time. I don't even know where I am or what I'm doing. And a lot of you had a good laugh last week where I talked about my laptop that I spilled water on a couple Thursdays ago and broke it. I am still using the new laptop, so I'm still breaking that in. I'm like, how do I print on this? How do I do certain things? So I'm still breaking the laptop in, but it apparently is working. So far so good, having this laptop for about a week approximately. All right, so now let's just kind of dive into it. Again, this is the 49th episode of Carson's Facts versus Feelings with Ryan and Sonu. We title it again, Busting 7 Common Myths. We're going to do our best to kind of hit these quick. Some of these we've actually talked about before, to be very honest. But I think it's just an important thing. We've been asked by a ton by our partners and their clients, some of these. So we just wanted to touch on some of these. No necessarily randomness to this, but I guess I've got credit cards first. We did talk about credit cards recently, but we'll do it again high level. Over $1 trillion, Sonu, of credit card debt, all-time record, just recently, according to our data from our friends at the Fed. Should we be worried? How worried should we be about $1 trillion of credit card debt? They tell us it's a lot. Sounds like a lot.
I never want to say I'm not worried at all, because you never want to say that. But no, I'm not too worried about that. I mean, it gets to something you always point out, which is denominator blindness. Right. Mm-hmm. Okay. Debt as a percent of what? Right. A percent of total assets. Total assets are up a lot over the last couple of decades. Right. More than 20 trillion. Even if you take nominal GDP, that's up to 28 trillion now. Right. So as a percentage of that, it's not too much. And in fact, over the last quarter between Q1 and Q2, credit card debt was kind of, didn't move up, to be honest, not by much.
Exactly. Just overall debt, I think it's about $17 trillion, again, according to data from the Fed, and about $13 trillion, that's mortgages, $1 trillion or so credit card and different types. But again, just overall, it was like 17, I forget exactly, like 0.03, it went to like 17.04. So overall debt really didn't explode higher like we're told. Again, if you look at overall net wealth, debt equity, People are worth a lot more. Housing prices have obviously gone up. Equity prices over the long term have done well. Bonds, maybe not quite as much, but nonetheless, people are worth more. So I think it makes sense that there's a lot of more credit card debt out there. You have to look again at the denominator. So Sonu, that's our first one. Let's go to another one. I don't think we've talked about this one on the podcast. That was quick, but hey, we got 7 of them. You and I like to talk a lot, so we have to do our best to try to stay on task here, because I've got some stories and things to talk about. Student loans, right? We've heard a ton about student loans. People didn't have to pay them for the last couple of years, and now all of a sudden we're hearing about these payments are coming back. What does that mean for the consumer? If there's a strapped consumer with record credit card debt, with higher rates, we'll talk about higher rates in a little bit also. All these different things, now people are going to be paying, I don't know, anywhere from a couple hundred or maybe $1,000 a month more. How worried should we be about student loan debt payments coming back?
Again, not too worried, at least myself, right? Look, student loan repayments are set to restart in actually 2 days, right? Beginning of September. And that's because the Supreme Court struck down the Biden administration's plan to they were going to cancel up to $400 billion in student loan debt, and that's about 28 million borrowers, as a concern. And I think it's fairly valid. Okay, will this result in a big crash in consumer spending? Anytime you hear the word crash, by the way, in the media, do a double take, right? And think about, does that actually make sense? And turns out, look, Americans are paying about $70 billion towards student loans. This is before the pandemic, 2019. That's equivalent to the amount they spend on gas services or internet services, right? So it's a big amount. And you think, resumption of these payments is going to constrain consumer spending. I don't think crash, constrain it, right? But I think the impact's going to be muted. A lot of Americans were continuing to pay down the loans during forbearance, right? During the period when they didn't have to pay anything, people still paid it. So the principal amount actually went down. And then the Biden administration recently canceled about $39 billion in loans for about just under 1 million borrowers, right? So these are people on income-driven repayment plans. And there were a lot of mistakes on the administrative side, tracking payments, all of that. All these errors are sort of like, they fixed all of them. And turns out a lot of borrowers had their debt forgiven altogether, right? And then the administration's also planning a loan on-ramp for those who have to resume payments. So like for the first 12 months, they don't have to start, on day one. They can slowly ramp up payments. And there's not going to be any, sort of problem with respect to, they won't be reported to collection agencies, things like that, right? So all in all, and even, after the Supreme Court made the decision, turns out we're not going from 0 to 70 billion. 70 billion was what they paid before the pandemic. We are already halfway there. A lot of people have started making payments again because they know, come September, yes, I don't want to be surprised. So I'm going to start payments in, say, July or August as well, right? So the Department of Education has seen, half of those payments come back into their coffers, really.
Well said there. I look at us, my family or my wife, we still pay her student loans. I joke are going to pay her student loans. So my daughter, Susanna, goes to college. We never stopped paying them. I was still employed. I just kept paying it. I know that this is something the media doesn't point out a lot. There are a lot of people that just continue to pay. They say, well, I'll just keep paying it. I got to pay it eventually, right? If the government wipes it away, hey, I'll take it. I don't expect that to happen. It didn't happen. But so there's a lot of that as well. So again, we're aware it's in the media. And again, hey, it is money out of people's pockets in theory, but let's not forget there was a long time people actually paid their student loans and the economy did just fine. And we don't think this time's going to be very different. So that's we've done credit card debt, student loans. Let's go to excess savings, right? There was over $2 trillion of excess savings during COVID. Again, the government gave people money. People just kind of stayed inside. They weren't sure about what was happening. So believe me, they saved money. And I don't know the exact details. I don't know if anyone really does, but we're hearing the excess savings is almost gone, or maybe it is gone, depending on who you look at and what time frame you use. So Sonu, that's something we've heard for, honestly, years now. Excess savings going down. It's going down. Once that's gone, that's the next, how do I want to put it? That's the big first domino to fall. The excess savings is gone. Again, I'll hand it to you in a second. There was a time we didn't have excess savings and the economy did just fine. We had excess savings. We had a 100-year pandemic and we were shut down. And the other side of that is where we are now. So to me, it's like, hey, we're actually getting back to normal, right? The path to normal, the road to normal. It's normal not to have a ton of excess savings. So Sonu, I'm going to turn it over to you now. What's your take on the excess savings likely depleted soon or even now, depending on, I guess, your source?
How are we doing on time? No, I was kidding. I won't take too much time with this. Look,
Yeah.
I'll just start off by saying, I'll talk about excess savings, but all the consumption, and the large amount of consumption they're seeing right now, that's coming out of incomes, period, right?
Yep.
That's it. It's not coming out of savings right now. Now, excess savings was basically, as you said, it depending on how you calculate it, it was about 2 to 2.3 trillion that households accumulated over the pandemic because they were at home, they didn't spend too much, and they got checks from the government, right? And again, the San Francisco Fed staff members looked at it and they said, you know what? There's only 190 billion of that left. Right now, depending on how you take the time frame, all of that, like I came up with a calculation where it could be 500 billion, it could be 190, it could be 800 billion, right? But anyway, and that gets to part of why excess savings right now, it really doesn't make sense as a concept. And it gets to the fact of how it's calculated. Excess savings is calculated as a difference between actual savings, right? Actual amount of savings households are doing, consumption minus, or income minus consumption, versus estimated savings. How much savings would they have had if incomes went on the same trajectory as before the pandemic and consumption also went on that trajectory? So at some point, the difference just gets, you're so far away from pre-pandemic that it doesn't really make sense, like I said, as a concept really anymore. A better way to do it, look at how much excess liquid cash households have, right? That spiked after the pandemic. And Ryan, that's not moved lower recently. So I looked at checkable deposits, savings, CDs, money market fund shares. Before the pandemic, they had, if you had continued on that trajectory, these deposits and stuff, because nominal GDP is growing, they continue to grow every year, right? Households would have had about 13.5 trillion, right? Altogether, checking account, savings, CDs, money markets, right? Right now, they have 17 trillion, about 3.5 trillion more than you would have expected if the pre-pandemic trend had continued, right? So that tells you, look, excess savings doesn't make sense as a concept, but there's a lot of excess liquid cash that households have right now.
Yeah, I just pulled up Fred just on my phone here. Personal savings rate, it soared to over 30% during COVID. Again, that's what we're talking about. Then recently bottomed out. Oh, gee, I'm again looking on my phone. I mean, around 3% approximately, looks like, right around 3% of September 22. But, recently personal savings rates up to 4.3%. What I'm getting at, savings was high, then it was low, but people are actually saving more if you look at personal savings. Hey, excess savings, maybe it's depleted or it's close to. But again, this is something we hear a lot about. It's been in the media. But again, maybe it's not quite the concern that the media make it sound to be. So, Sonu, we're going to talk about retail being weak here in a second.
All right.
You mentioned something earlier about people spending and doing things, and I was just thinking about the idea that we cut the cord finally from DirecTV.
Congratulations.
And then I'm thinking, well, we were spending a ton of money. Yeah, I think 14 or 15 years. And I did it. And then I was thinking, like, we talk about this, in theory, I'm saving money because we were spending a couple $100 a month for DirecTV to have all the different stuff. And I'm just looking at my phone right now. So now we pay for Netflix, we pay for Amazon Prime, we pay for Max, we pay for Peacock, we pay for Hulu. I pay for Fubo TV. That's a new one we get to watch live TV. I think there's Paramount Plus is in there. Sirius XM is in there. Those is like one page of my Disney Plus. Of course, who doesn't pay for Disney Plus? Oh, and then Sunday Ticket. I just get $500 to Google for NFL Sunday Ticket. So you add it all up, and I'm not even sure if we're saving any money. We're just buying it from like 19 different places. Do you guys? You do a bunch? You do that? I think that's what we're all doing anymore. We just buy all these silly things. And my boy's like, we got to have the NFL. I'm like, yeah, we do have to have the NFL. That was why we had DirecTV for the longest time. Had the NFL Sunday package, no more. So I said, let's cut the cord and just give money everywhere instead of one place. How about you guys? How do you do it?
We cut the cord a decade ago, but without getting myself into trouble here, I'm just going to say we do some sharing, some password sharing here and there.
No,
that's all I'd say. Shh.
Yeah, you won't say who it was with. Well, you're a caring, sharing guy, so I guess that makes sense. I have no idea how we can do a segue to retail, but we'll just go ahead and do a segue to retail. We've had some high-profile misses. Now, let me get to my notes here, Sonu, because I know I have them here. Just give me 1 second. Just last week, we had Macy's came out. Their stock was down like 13 or 14%. They worried about Higher delinquencies. Here we go. Got it.
Yep.
Foot Locker. I mean, known tried and true brick and mortar company Foot Locker down almost 28% in one day. Peloton, one of the big winners during COVID, down 23% on some worrisome signs. Dollar Tree down 13%. You've got Macy's and Lowe's sales down 8% year over year for both of them. Dick's, I mean, we're a huge fan. We go to Dick's all the time. Just there last night with my boys. Dick's was down 24%. They cited, honestly, theft is one of the main reasons that they're having some trouble. Some of the other companies did as well. So, Sonu, that's where I'm going to set it up. Some high-profile misses from some very well-known retailers that we know and love and use all the time. How worried should we be there? Because the media, again, is telling us it's a sign the consumer is cracking.
Oh, I feel like I keep repeating myself and saying I'm not too worried. But look, I guess you just said you went to Dick's. But I'm trying to think about the last time I went to a store to pick up, like, I don't know, shirts or T-shirts or something. I don't know. I buy it online, and if it's not the right size, Amazon makes it really convenient for me to ship it back and get another size, right? Like every now, obviously groceries and stuff. I go to, whether it's Costco or we have Mariano's here, right? Or a Jewel or something like that. Or the neighborhood Mexican grocery store. That's where I go get my stuff, right?
Ooh. You're getting me hungry, Sonu, talking about some of these things. I'm hungry, yeah.
But see, the reality is a lot of us are spending less on goods. And even if than we were a couple of years ago, right? So you probably couldn't tell by looking at, how many Amazon boxes come home, at least to my place. But that also gets to a lot of spending has moved to online. I mean, you're not doing a lot of brick and mortar sales. Speaking of Macy's had this massive flagship store on Michigan Avenue in Chicago, like the Magnificent Mile. They had like a 6-story or 7-story store, and they shut the whole thing down a couple of years back. Just close the whole thing. Boom. Nobody is going there, right? I can get everything on Amazon. I can get everything, I want even from Walmart or Target delivered, right? And there's a Target like 3 blocks away, by the way. I never go there. My wife likes going to Target. She thinks it's therapeutic. Sure. But, I leave that to
my daughter is always like, Dad, let's go to Target. I said, if we're going, I'm sitting in the car. I'm not going in there. Not that I just don't like shopping. And anyway, yeah. No, and you mentioned Walmart. So again, Walmart came out with some decent earnings, honestly. This was maybe 2 weeks ago at this point. But they said, hey, online sales are increasing. We are seeing across the board, it's just this dynamic, this shift from the brick and mortar stores again to doing things online. I think I had something else. Oh, Lowe's. Lowe's was one that actually came out with positive news. And by the way, Guess was up 26%. Couldn't tell you the last time I was going to guess. But it's not like all these retailers are just crashing and burning. Guess had a huge move higher. And Toll Brothers, I'm aware it's not a retailer, but you think about the biggest thing you can buy is a house. Toll Brothers actually guided higher. They beat by almost 30%, and total home sales actually beat by almost 6%. So you can pick some negative, you can pick some positive. Here's the final comment on this, Sonu, then we'll go forward. Consumer discretionary was actually higher last week. If all you saw were those headlines of how terrible everything was, you think, oh my goodness, CD had to have been crushed. No, consumer discretionary was actually higher last week, again, because some of these companies have been in trouble for a while. Like you mentioned, Macy's, it is what it is. They've been in trouble for a while. Kind of getting some negative news out there, but there are some positive things out there. Go ahead.
I'll just say, anytime any company is in trouble, it's not, I'm not saying this is the CEO's fault or anything like that, but usually like, if the company's in trouble, it's a problem with the macroeconomy. But if the company is doing well, it's all credit to management, right? But look, everyone's, at the end of the day, people as well spent a fortune on Taylor Swift concerts, Barbie, Oppenheimer. By the way, the U.S. Open tennis just started in New York. Fan Week, attendance at Fan Week was at an all-time record.
That's interesting.
Put a period in that.
Yeah, we've seen some numbers, and I don't have them off the top of my head, but like just in Major League Baseball, right? Major League Baseball's having like huge attendance. We know NFL, college football season's here. Thank goodness, everybody, big college football. Anyway, so there's different ways. I think if you talk to most people under the age of 35, they'd say, you know what? I don't want to spend money on stuff. I want to spend money on experiences, and they're still out there spending. It's just kind of how they do it. So, all right, so that's good discussion there. Let's go to another one here. We have heard a lot about the surge in bankruptcies, right? There's data that we see that shows more and more bankruptcies taking place, like some of the most we've seen to start a year in a good while. They were low, now they're surging again. Sonu, you did some amazing work in your daily note. We call it Sonu's Daily Note. That goes out to our more than 350 Carson partners. Did it recently. You had some pretty interesting factoids on bankruptcies going higher and what it really means. You want to take it away?
Yeah, so bankruptcies are going higher, but three things counter that, right? Anytime you think corporate bankruptcies, what do? You know what? Look at you and I like to think of them as some of the smartest investors in the room, the credit markets, right? Because they're the ones lending money to companies. If they're worried about rising bankruptcies, rising defaults, what are they going to do? They're going to charge companies more interest. Especially the spread, right? The credit spread, the spread between how much they charge a company and how much they charge the government, basically, for risk-free rates, or like a 10-year treasury or 5-year treasury, whatever it is, right? And those spreads have actually been coming down, right? So in fact, that's telling us that the risk of defaults is actually going down as far as credit markets are concerned, right? So that's one.
Right.
The other one is, if you look at okay, so credit markets do a lot of lending to companies. Who are the other folks who lend to companies? Banks, right? You look at all commercial banks, and delinquency rates for business loans, that's running under 1%, right? That's running below where it was before the pandemic. And over the last 30 odd years, 34 or 35 years, the non-recession average delinquencies was close to 3%. Like I said, right now, as of Q1, it was running at 0.97%, right? So business loan delinquencies have also been falling. And then you talk about entrepreneurship. That's the other side of bankruptcies, right? So the IRS tracks business applications. And usually these go up during recessions because people are like, you know what, I'm unemployed, I'm going to start an own business, right? But they also track business applications with planned wages. So these are businesses more likely to turn payroll. And that's running at the highest levels, over the last decade as well, right? So you take all those three things. Credit markets are saying we don't think there are rising defaults or the risk of rising defaults. Bank loan business delinquencies have been falling. And then the opposite side, the other side of the coin of bankruptcies, entrepreneurship with planned wages, that's also rising.
Well said. I mean, you shared some really cool charts on this, but the business applications surging is the one that got me, right? I think we had the data of the first 7 months of the year relative to where we were the previous first 7 months, and it's the most we've had in years. Now, who knows what's going to happen the final 5 months? But again, it just runs counter, I think, to what we are hearing and seeing. And like you mentioned, delinquencies, we've seen some auto loan delinquencies and some other delinquencies, which have been starting to pick up. They're almost more normalizing off historically low levels of where they are. But, an interesting discussion, one we're going to keep following. Sonu, we've got two more things we wanted to talk about. The idea of higher rates going high, or rates going. Yeah, well, that's why I write this stuff down. I don't even know what we're up to. Higher rates are bad for the economy, stock market, and then government debt. And again, we've probably talked about some of these. So before we go there, I mentioned Netflix. Netflix, I don't know if it's a new show. It's not a new show, but maybe they just showed it. But The Big Short. So remember The Big Short? It's great. It was on. I haven't watched it probably for 10 years. I saw it just the other night. I was kind of hanging out. I said, you know what? I kind of want to watch that. And I watched it, and it just was amazing. You look back at the financial crisis, all the different things that happened. And
is that the one where Margot Robbie is sitting in the tub and explaining?
I was about to say,
Margot videos or something.
Yes, they're like, and to describe. I was actually going to point that out. To describe a credit default swap, here's Margot Robbie in a bathtub, and she's sitting there in a bathtub drinking wine, and explaining it, and it just. I mean, of course, it's got to be funny because this stuff's. Sure. I mean, I say that I do this for a living. I think it's boring to talk about the Fed all day. You got to tell some stories, have some fun with it, and clearly that movie did. But if you haven't seen it in a while, it just was a kind of a good thing to remember that, we've had booms, we've had busts, we're going to have more of them. We don't think we're going to have a financial crisis anytime soon, but hopefully we all live long enough to see another one. And it's probably going to be another opportunity, but it's not going to feel like it in the midst of it. But just, I don't know. It was just a pretty good show with some good laughs and things. What's your favorite financial show ever, though? Do you have one off the top of your head? Or maybe want me to go first? I was thinking of this.
I liked Margin Call, and I like Trading Places, I think. Trading Places is the one with that really old one from the 80s, right? That was great. A good one. Yes, I think off the top of my head, those are the ones I would.
So I would say, Wall Street, the first Wall Street, of course, is just like, that's like the Bible. But I'll tell you, I think Wolf of Wall Street's my favorite. I think it's got more F-bombs in it than any movie in history. It's hilarious. I just think it's hilarious. I like that one. I love Wolf of Wall Street. Now you kind of know how my humor is a little fun.
Has Stallone done a Wall Street movie? I don't think so, right?
I don't think so. But I will. We can go off a tangent. Expendables 4. Ooh. I am an enormous Expendables fan. Expendables 4 4 comes out on September something. I don't know. I'm going to have to take the day off and go watch. I never watch movies in the theater. I mentioned I did see Oppenheimer in the theater. I was like, I gave it like a B minus. I didn't like Oppenheimer, so shoot me. But I love Expendables.
To get an A+ from Ryan Dean.
Well, so here's the thing. Expendables 3 was PG-13. It drove everybody crazy.
Really?
Watch the trailer. They say this is rated R. We heard you loud and clear. They say there's going to be, everything. So they're going rated R for Expendables 4, the way it should be if you grew up watching 80s action movies. All right, Sonu. So we're doing pretty good time-wise here.
More services spending. That's what
exactly. So let's spend a little bit of time here, try to get us back on path here. Rates have been going higher, right? You've got mortgages at some of the highest levels we've seen in a long time. The 10-year yield highest since 2017. That's creating the credit card debt. Or no, not credit card debt. Sorry, but credit card rates on credit cards are the highest levels we've seen in a long. I've seen some over 30%. I mean, those things are real, right? If you have debt, it's going to cost you more now. Now, the flip side of that is savers. We're finally in a world where savers can actually make some money. You're getting 5% in the money market, right? Give or take. So there's a yin to a yang of everything. But let's talk a little bit about that. How worried should we be with the 10-year yield going higher and some of these longer-term yields going higher? What's your take?
Here's why I'll put it as, if rates are rising rapidly, that worries me a little bit, because that means the Fed's getting really aggressive. That's what we saw last year, right? That's never a good situation for equities, because your discount rates, like, without getting into your valuation, how you think about that, all of that has to change, right? But look, right now, let's talk about rates, right? So markets expect the Fed to max rates out about 5.5%. That's the so-called terminal rate, right? But as you said, long-term rates have been going up as well, like the 10-year yield, right? Now, a simple way to think about this is long-term rates are what markets expect short-term rates to be in the future. So it's almost like, when you look at long-term rates, that's what markets expect policy rates, monetary policy rates to be, say in 2027. So if you look at 2027, at the end of 2027, what markets expect the policy rate, the federal funds rate, right? That's what the Fed says. They expect that to be 3.8% now. At a month or two ago, it was about 3.2%. So those implied policy rates in the future have gone up, right? Why? Let's talk about that. Is that a bad thing? And it gets to whether you think high interest rates are bad for the economy or not, right? Rate expectations have actually risen because, look, we've gotten really good economic data recently. Over the past year, GDP growth has grown 2.6%. It's above the pre-pandemic pace. And that's in the face of a really aggressive Fed. They've raised rates from 0 to more than 5%. And there's no slowdown, right, Ryan? We talked about the Atlanta Fed GDP now saying Q3 GDP growth is what? Close to 6%. Even shave that in half, even 3% would be amazing, right? Basically, the economy proved its resilience to aggressive rate hikes. And now investors are extrapolating that to mean, we're going to have a high pressure economy for the next several years. What does that mean? That means there's going to be more upward pressure on inflation. That means rates have to be higher. We had high rates in the late 1990s as well. 10-year yields from 95 to 99 averaged over 6%. 30-year mortgage rates during that time, Ryan, average more than 7.5%. I'll just leave it at that.
Last I checked, the economy did okay, and the stock market did just fine. So, and again, we talked what you just summarized there. Just please listen to last week's podcast. I think we titled it "Recession." Guess the economy didn't get the memo, where we talked about the strong economy we're seeing, and again, why are longer term rates going higher? Well, our take, again, is the economy is strengthening. And one other thing, so we've got longer term yields breaking out. Look at the 2-year yield. The 2-year yield has not broken out to new highs. So again, that's what the kind of what the Fed might be up to. So again, there's different scenarios, different ways to look at it, but that's what's in impact or interesting to us. And you already talked about the credit markets. The credit markets, look at triple B spreads, things like that. Keep it real simple. Again, smartest guys in the room. If there was more stress, if you're worried about these companies that don't have the best credit ratings, can they pay you back? Well, you're going to charge them more. You're going to charge them more. We're not seeing that currently in the credit markets. We've seen stress in the credit markets before the last 3 or 4 major recessions and pandemics and all the bad stuff that's happened. We're not seeing that yet. So again, one thing to remember, savers are finally being rewarded in this type of an environment. For the longest time, people say, I can't get anything out of my cash. I can't get anything out of my bonds. There's no yields. Well, now they're actually getting that. Now we're kind of complaining to the other side. So again, it's interesting, but it's just kind of where we see things as we wrap it up, that higher rates. Again, historically, just look at the 10-year yield. Historically, when the 10-year yield has gone higher, stock market's actually done pretty well. And again, if it's because the economy's strong, small caps also historically do pretty well, an area that we do still like. All right, so now I guess the last thing, the seventh part of the 49th episode of Carson's Facts versus Feelings, Ryan and Sonu, titled it Busting 7 Common Myths, Government Debt. And I know we've talked about this, on and off, but again, it's a common one that we hear a lot about. The government has $31.4 trillion. We keep kicking the can, is the lingo that we say, as we keep increasing the debt ceiling and
we're going to leave it to our children.
Going to leave it to our children, going to keep just hammer their futures and hurt our grandchildren's futures. How true is all of that in your opinion?
By the way, you had a nice segue into that, because you said that, the savings yields are going up, and people are getting, for years you had the complaints like, oh, I'm not getting anything on my savings. Now you are.
Yep.
That's the yin. What's the yang to that? That's government debt, right? And it's just a reminder that the government debt, that's a liability for the U.S. government. That's what everyone says. Oh my God, we're leaving it to our children, all of that. But it's somebody else's asset, right? So, and let's talk about whose asset that is, right? We have about close to, let's say, about $32 trillion in U.S. government debt, total debt, right? Okay. The Fed owns about $6 trillion of that. That's about 19%. Foreigners, everyone's worried, oh my God, we owe so much to foreigners. That's actually come down. It's only about 23% now. And then agencies, trusts, pension funds, things like that, they own about 22%. Turns out U.S. households and businesses now own the majority of U.S. debt, about just under 12 trillion. It's about 37%, right? And, for all the folks worrying about China, oh my God, China's going to sell treasuries, and then, that's going to be our doom. Look, Chinese relative holdings of, out of the foreign part of foreign holders, right? China used to hold 20% of that back in 2014. That's fallen to 11%. So the foreign holders of treasury debt, that's shrunk as part of the pie. And then China's relative holdings, even within that, have shrunk even more, right? And then you think, so the biggest beneficiaries of higher interest rates is basically who? It's U.S. households and businesses, right? That's as you said, that's the yin to the yang of government debt.
Great points there. And for the longest time, again, we heard China was the largest holder of our treasuries, of our debt. And if they wanted to hurt us, if we really got into it versus a physical war, we could have a war in some of the markets like that. They could start to sell our treasuries, pressure our yields higher. We heard that for a long time. Yields stayed low for a long time. Now yields are going higher. And I don't think it's because China's selling. I think it's because, again, the economy's better. But interesting thing is now Japan, and they've been there for a minute, Japan is actually the largest holder of U.S. debt. It is no longer China. So again, did you do a blog on that? Didn't you do a blog on the China stuff? Right?
I did a note for our advisors.
Okay.
I did a note.
Okay.
But maybe I'll turn it into a blog. Yeah.
Yeah. Oh, the weekly commentary. The weekly commentary this week that went out to our advisors and their clients. But maybe sometime soon, Sonu might do a blog on that, because, again, we hear so much about China slowing down. How much does it impact the United States? What does it all mean? They could just sell our debt, as we just kind of talked about. We're not so sure China slowing down really going to impact the United States as much as it maybe would have in the past. And also, they don't hold nearly as much debt as they once did.
How much time do we have? Can I add one more note on that? Just a little tidbit.
It depends how good it's going to be. I mean, it's just like, it's just really good stuff. I'm teasing. We got all the time in the world. Why not? Let's talk about government debt. Let's do it for a couple more minutes. Sure.
So, you take, I said, like, foreign holders of government debt, that's about, a quarter, right? A little under a quarter, 23%. Out of that, a quarter of that, so 25% of that is in countries like, the Caymans, Ireland, Switzerland, Luxembourg, the UK.
Oh boy.
And these are all places we'd like to visit. But the thing is, what else do they do? They're all places where businesses shift their headquarters for tax shifting, right? So these are U.S. companies shifting taxable income outside the U.S. to these amazing places to avoid U.S. taxes, right? Like tech and pharma companies. But by the way, all that money, that excess money they're trying to avoid taxes on, U.S. taxes on, that's invested in U.S. Treasury debt, government debt, right? So even from that perspective, when you look at like foreign holdings of government debt, remember a chunk of that is actually U.S. businesses.
Wow. So it's foreign holdings, but it's really not foreign holdings.
Yeah.
square that one. That's oh boy. Now we got another conspiracy theory. So anyway, that's interesting. All right, well, everyone, so Sonu, thanks for making it. I don't think you're glistening quite as much as you were 30 minutes ago. But thanks to all thanks to all the listeners for the 49th episode of Carson's Facts versus Feelings. Next week's the 50th. Sonu promises to break out his guitar. He didn't promise it, but
I got a good one. I have something in mind.
Okay. Oh boy, you got 7 days to start working on it a little bit. So that'll be. Oh, I have to sing. Oh, never mind. We're not going to do that. I take it back. I take it back. But everyone, thanks again for listening. That was hopefully an interesting discussion on some of the bigger myths that we continue to hear as we kind of went myth busting in the 49th episode. We'll be back next week with the 50th episode of Carson's Facts versus Feelings. We'll see everyone then. Take care. Thank you.